In December 2020, the U.S. Securities and Exchange Commission, the SEC, dropped a bomb on the crypto world. They sued Ripple Labs, accusing it of selling over $1.3 billion worth of unregistered securities in the form of its digital token, XRP. The news sent shockwaves through the market. Overnight, major exchanges began delisting XRP. Panic set in as investors rushed to sell. But this wasn't just another lawsuit. It was the opening shot in a battle for the very soul of cryptocurrency in the United States, a fight that would challenge the definitions of money, technology, and regulation itself. To truly understand the magnitude of the Ripple versus SEC case, we have to go back to what made XRP unique in the first place. While Bitcoin emerged as a rebel currency, aiming to bypass traditional finance, and Ethereum built a new world of decentralized applications, Ripple took a different path. From its inception, the company focused on working with the system, not against it. Its goal was to use blockchain technology to make cross-border payments faster, cheaper, and more reliable for banks and financial institutions. This business-friendly approach made Ripple one of the most valuable and well-funded fintech companies in the world. But to regulators, this proximity to the traditional financial system also made Ripple an easy and highly visible target. Then, on December 22, 2020, just before the holidays, the hammer fell. The SEC officially filed its lawsuit, charging Ripple Labs, its CEO Brad Garlinghouse, and co-founder Chris Larsen. The commission's central claim was explosive and simple. XRP is not a cryptocurrency like Bitcoin or Ethereum. It's a security. According to the SEC, Ripple had raised over $1 billion since 2013 by selling XRP in an ongoing unregistered securities offering to investors around the world. This single accusation threatened to unravel not just Ripple, but potentially the entire altcoin market in the US. If XRP was a security, what did that mean for countless other tokens? The storm had begun. The immediate fallout was brutal and swift. Within days of the announcement, major US-based exchanges, which had been the primary gateways for everyday investors to buy XRP, started heading for the exits. Coinbase, Kraken, and Binance US, among others, announced they would suspend XRP trading. For these publicly traded or heavily regulated companies, the risk of being seen as an unlicensed broker of securities was simply too high. The effect on the market was catastrophic. Investors, fearing the token would become worthless in the US, were furious. The price of XRP, which had been performing well, crashed over 60% in a single week. The digital asset lost billions in market capitalization, wiping out portfolios and shaking confidence to its core. Yet, in the face of this market collapse and regulatory onslaught, something unexpected happened. The XRP community didn't vanish. It didn't surrender. It fought back. A decentralized global movement of supporters, famously known as the XRP Army, mobilized online. They flooded social media platforms like Twitter with hashtags and messages of support. Their core argument was clear and powerful. This wasn't just about one company. Crypto innovation itself was under attack by a regulator that didn't understand the technology it was trying to police. They argued that the SEC's actions were hurting the very retail investors it claimed to protect, and they weren't going to stand by silently. While most companies facing the full weight of the SEC might have sought a quick settlement to limit the damage, Ripple decided to do the unthinkable. They chose to fight. From the outset, CEO Brad Garlinghouse was defiant and vocal. He publicly stated, "This case isn't just about Ripple. It's about the entire US crypto industry." He argued that settling would mean accepting the premise that XRP was a security, setting a disastrous precedent for everyone else. Ripple assembled a powerhouse legal team and prepared for a long, expensive, and high-stakes legal war. Their defense rested on a few key pillars. First, Ripple's lawyers argued that XRP functions as a currency, a bridge between different fiat currencies to facilitate payments, not as an investment contract in a common enterprise. They pointed out that XRP's value is derived from its utility, just like Bitcoin or Ethereum, both of which the SEC, through public statements by high-ranking officials, had previously declared were not asterisk securities. This created a crucial contradiction that Ripple's team would hammer home again and again. Their second major argument was the fair notice defense. How could Ripple be guilty of breaking a law that wasn't clearly defined? They claimed the SEC had failed to provide clear rules for the crypto industry, instead opting for a strategy of regulation by enforcement, suing individual players to create rules through court precedent. It was a bold counterattack, accusing the regulator itself of being unclear and unfair. For 2.5 years, the legal battle raged. Both sides filed countless motions, deposed key witnesses, and fought over every piece of evidence. The crypto world watched every development, with each minor ruling being dissected for clues about the final outcome. The case centered on complex legal tests, particularly the Howey test, a standard from a 1946 Supreme Court case used to determine what constitutes an investment contract. The SEC argued XRP sales met all prongs of the test. Ripple argued they did not. One of the most contentious points of discovery was a set of internal SEC documents related to a 2018 speech by then-director William Hinman, where he declared Ethereum was not a security. Ripple fought relentlessly to get these documents unsealed, believing they would prove the SEC's internal inconsistency and lack of a clear policy. Then, in July 2023, the turning point arrived. Judge Annalisa Torres delivered a partial summary judgment that sent shockwaves through the industry. The court made a groundbreaking distinction. It ruled that Ripple's direct sales of XRP to institutional investors did constitute unregistered securities offerings. But, in a massive victory for Ripple, the judge ruled that XRP sales on public, secondary exchanges, the way most retail investors buy their tokens, are not securities. The court reasoned that these buyers had no idea they were purchasing from Ripple and were unpromised profits based on the company's efforts. The crypto community exploded with celebration. The price of XRP surged over 70% in hours. It was a huge symbolic win, a validation for not just Ripple, but for every project that had been living in fear of unclear regulation. But the war wasn't entirely over. The win was partial. The SEC had still won on the point of institutional sales, leaving Ripple facing potential penalties for that portion of its past activity. The regulator, unwilling to accept defeat on the broader issue, quickly announced its intention to appeal the part of the decision regarding programmatic sales on exchanges. The fight would continue, but the landscape had been irrevocably altered. Ripple had proven that the SEC was not invincible in court, and a federal judge had provided a potential framework for distinguishing between different types of token sales. The Ripple case became more than just a legal dispute. It became a global symbol of the friction between innovation and regulation. It highlighted how technology, especially in a borderless and fast-moving field like crypto, often outpaces the ability of governments to understand and legislate it. While regulators in the United States struggled to fit digital assets into century-old legal frameworks, builders, developers, and entrepreneurs around the world kept pushing forward, creating new financial tools and protocols. The lawsuit exposed a deep and uncomfortable truth for the industry. In the world of crypto, regulatory clarity is just as valuable as elegant code. Without clear rules of the road, the fear of sudden enforcement actions stifles investment and drives innovation to more welcoming jurisdictions. Ultimately, the Ripple versus SEC saga has been a long, costly, and painful ordeal for everyone involved, but it has forced a critical conversation into the open. It has pressured lawmakers to consider new legislation tailored for the digital age and has shown the entire industry the importance of proactive compliance and robust legal strategy. The case proved one thing, above all else: regulation can certainly delay and disrupt innovation, but it cannot stop the relentless march of progress. The demand for faster, cheaper, and more inclusive financial systems is a global force, and the technology to enable it will continue to evolve, with or without the blessing of any single government. This is DCA Crypto, where we tell the stories that shape the future of finance. If you found this story insightful, be sure to like this video, subscribe to the channel, and hit that notification bell so you don't miss our next deep dive. Thanks for watching.